There's been another economic boost that has happened recently. We're going to talk on how that concerns you, how that affects you with Bill Davis and Matt Aurenz today on Your Wealth Health. Hello and welcome to another episode of Your Wealth Health. I'm Erik Brenner, president and founder of Hilltop Wealth Solutions, and I'm glad you joined me here this morning. If you are watching us on Facebook, if you could hit the share button and share the great information we're going to talk about today, and also if you're watching us online, thank you for that. There continues to be a lot of talk, obviously, about the economy and the CARES Act that was recently signed a couple of weeks ago, and many of you are affected by that and should be receiving some relief if you haven't already. But there was also some interjection from the Fed recently, and we want to dive into that. And with me today, we are social distancing. I'm in the studio practicing that with a camera person, and I have a couple of our advisors who are at their homes, Bill Davis and Matt Aurenz. And thank you for joining me today.
Happy to do it, Erik.
Yep. So let's talk about the Fed and what they tried to do. Recently, there was a $2.3 trillion announcement. And I think a lot of folks get really confused pretty easy about what the Fed is doing and what they are trying to do to really help at least minimize the damage in our economy right now.
Well, yeah, it becomes confusing, I think, to our viewing audience as the stimulus packages are coming from all different directions. So we thought today in our show that we would try to differentiate those stimulus packages from what's coming to individuals and to what's affecting the markets. So I think we have a slide that talks about the differentiation of this and allows us to see that the Federal Reserve is infusing capital into the markets, primarily into the bond markets, which many people don't understand that the bond market is significantly larger than the domestic and international stock markets combined. So the bond market, it comprises over $100 trillion in assets that if frozen or if not operating properly with the amount of liquidity, could be a big issue for our stock market as well. So I know Matt, you've looked into this quite extensively as well.
Yes, that's a great point, Bill. It's all about liquidity at this point. And if you seize up the fixed income bond market without liquidity and the ability for people to continue to pay their debt obligations, what ends up happening is you have a lot of default. And that default then will have that trickle-down effect. We saw this with the Bear Stearns back in 08-09 in the financial collapse. That was just kind of the beginning. And I think what the Fed is trying to do at this point is minimize that same effect. I don't think companies by any stretch of the imagination are in that type of shape at this point, but they just want to make sure that they're working in advance for liquidity to be there so that they can stymie any of that type of concern. And so by infusing capital into the fixed income market, providing liquidity, it's allowing corporations to pay those debt obligations. Additionally, they're throwing money into the municipal bond world that is allowing your state municipals to pay their obligations. And they're also buying riskier assets. They're buying high yield. Sometimes people refer to those as junk bonds, but they're buying those riskier assets because, again, the goal is to minimize any type of default, any type of bankruptcies, because that's the first place that many corporations go to get working capital beyond the stock market.
Yeah, and I think that we were surprised last week with the Fed adding high yield and municipals to the purchase agreements, as well as now using exchange traded funds as well, Matt, right?
Correct. And the exchange traded fund is just, it's providing liquidity. The difference between an exchange traded fund and a mutual fund or owning an individual corporate bond is it's a person to person transaction. A mutual fund is going to be a person to a corporation, a mutual fund company transaction. And so that corporation is obligated essentially to buy your shares back when you're selling them. An ETF, however, is an individual to individual transaction. So, but it's also a way that has really grown significantly in the fixed income world and the equity world as it tracks indexes. So, just infusing that capital in there, just again provides investors with more of a softening to understand that liquidity will be there, and they'll be able to get their money out if needed. And it just provides the government with low cost investing for helping out in the short term.
Yeah, and we really saw that in the AGG ETF, Matt. That thing bottomed out at about $106 a share from 118. And after the infusion of capital the first time from the Federal Reserve, again, this is the second infusion of capital into the markets. But that first time at the end of March, that we saw that ETF jump right back up almost to exactly where it was pre-crisis.
Right. And so, the iShares aggregate bond is one of the largest ETFs that tracks just the aggregate bond market index for the U.S. market. And I think a lot of people were concerned with the initial market decline, primarily because their fixed incomes, their safe money, if you will, also experienced significant decline, around 9.5% or so. And that's a pretty big drop when you're the investor who's saying, this is my conservative money. How does that decline so rapidly? And what we find is that in periods of extreme uncertainty, uncorrelated assets can become correlated. And that essentially happened. A little bit of fear in the bond market. You had this big sell-off. And you also had the sell-off because of concerns for liquidity. And that decline happened so rapidly. But you could see just with a couple acts of stimulus from the government, how quickly that came back. And it's back positive for the year. And it's 100% due to there's enough money being pumped into the fixed income market. There's enough paper being printed to ease the concerns of investors. And once again, those safe conservative assets are feeling like safe conservative assets, and people are collecting the interest payments like nothing ever happened.
And I think the experience, Bill, you mentioned liquidity, certainly Matt did as well, but the experience that happened in 08, 09, where the money market, there were several money market funds that what we call broke the dollar. So they're priced at $1. People invest in money markets thinking that their principal's not changing, and yet that dropped by 3 cents. It doesn't seem like a lot, but you have a fair amount of money in money market, and now all of a sudden something that you thought was guaranteed is now dropped. So liquidity is certainly important in each investor's portfolio.
Yeah, especially our retired clients are probably 50 to 65% in the bond market. So if you're a daily watcher of your investments, that first week looked pretty scary, but now the bonds are acting like they should within our clients' portfolios.
Yeah. Thank you guys for a great discussion, and we'll dive into this a bit more. So when we return on Your Wealth Health, we're going to talk a little bit more specific about how this may affect you as an investor, someone that's saving for or in retirement, as well as we're going to talk about should you look at resetting your financial goals. With now that we're in a recession, what does that mean to you when we return?
All of our vehicles do come with a warranty. The warranty is nice because whenever you get a vehicle, you're not sure what's going to happen. I mean, it's reasonable to expect that a pre-owned vehicle is going to have an issue, but the warranty is going to help you with any internal engine, internal transmission issues. So those are the big, ugly, nasty repairs. the ones that you need help with, and that's what we're here for. So if you're driving down the road and the transmission just stops pulling, give your sales agent a call, and we'll get the process started to help you get back on the road as quickly as possible.
At River Valley Construction Group, we pride ourselves on being one of the top deck builders in all of Michiana. If you want to have a beautiful deck, whether it be wood or composite, contact River Valley Construction Group today. River Valley Construction Group, where we're building your dream deck in 2020.
Welcome back to Your Wealth Health, and thanks for joining me this morning on Fox Michiana. If you're watching us online, thank you for that, whether that's on Facebook or on yourwealthhealth.com. With me today, we're practicing social distancing, and with me today is Matt Aurenz and Bill Davis, private wealth advisors with the firm, and thanks for joining me from your homes. And we're going to continue this discussion around a little bit more around the Federal Reserve and what they have done of recent in putting $2.3 trillion. It just seems like these numbers just kind of get to be natural, even though they're large numbers, into the system, and what it really means for our viewers. How is that going to affect them? What does it really mean? And what if they didn't do that, which I think the consensus is, our view as well as other experts' view, is that this is needed right now to keep us from going deeper down. So let's talk a little bit more about how this impacts companies and investors in general.
Yeah, I can start there. The checks are in the mail, as of what I'm hearing, as of last evening. So if you had a direct deposit on a routing number and account number on either your 2018 or your 2019 tax return, you'll be receiving your stimulus money as early as today and possibly by the end of the week for those that have routing numbers. I've had a lot of questions. What should I do with my stimulus money? And just like in any windfall, I normally recommend that at least 50% of that money goes to reserve. And so, building that cash reserve to not knowing how long this pandemic's going to go on and how long we're going to be social distancing, I think that accumulation of cash on your balance sheet is a good thing. And now that many of the loan payments and things have been furloughed, that's helpful in allowing our viewers to have a little bit bigger reserve with the uncertainty of how long we're going to be in this pandemic.
Yeah, so we have the CARES Act there, as you said, Bill. The checks are coming out to the individuals, and we're hearing somewhere in the neighborhood of 80% of taxpayers will receive a check. And then we have the Payroll Protection Act, which is it had some hiccups, if you will, in the system. But they brought this to the system really very, very quickly, wanting to get the money out. But a little bit more on the bond side, because I think on the Federal Reserve side, of course, it doesn't take an act of Congress as the CARES Act did. So we hear more about that, I think, in the general press about the House and the Senate and Democrat or Republican versus the Federal Reserve side. And so, Matt, I think bonds in general, and we talked about this in the previous segment, right? But bonds, because it's so large and what they did, we just want to emphasize the impact as we see it, how that may have helped plug a hole in the system, don't you think?
Yeah, it definitely plugged a hole in the system. Again, when you look at stocks versus bonds, a publicly traded company can suspend their dividends at any time. And so if you're that retiree who's living on a fixed income stream or using their dividends to provide for their income, and a company just suspends their dividend, there it goes. In the fixed income world, that is an obligation that has to be paid, that interest payment. So infusing the capital in there requires those debt obligators to pay that interest payment to you until that bond matures. So it's a huge win for for the retiree in particular, but anybody who owns a debt, is to make sure that they're still collecting on that coupon payment. And so the Fed, really, again, doesn't need the bipartisanship, just can go ahead and take corrective action as needed. The other side of the stimulus, the CARES Act, really is much more of an act of Congress. And so again, that's where Bill's point comes in of, we're going to send out stimulus checks to the individual taxpayer. We're going to help protect businesses, small, medium, large, with the various types of loans and grants. We're going to suspend people requiring to pay student loans for until at least October, basically the first payment's coming in. And while that's being furloughed, we're no longer going to charge you interest on that. Those types of, again, those are two different scenarios. There's the act of Congress that basically is saying, here's what we're going to do for the individual consumer and the businesses. And then you have the Federal Reserve, which is trying to just control the monetary policy, which has a much different source of and a different avenue on how that's actually influencing the individual and the business, not so much directly, because it's much more of a trickle down.
Yeah, it's a good point. And Bill, we like showing some graphics. I know a lot of people are kind of visual learners, so we wanted to put together a graphic. So if we take a look at the screen of that aggregate bond, and really how the dip. I mean, this really shows where we were at the beginning of the year compared to what happened in March.
Yeah, it was a short-term major change that was influenced by the Federal Reserve infusing capital, and I think they learned a lot from 2008, that they probably took baby steps in 2008. And they are throwing everything they have at it this go round to make sure that they don't, underdo it, so to speak. So I think they'd rather err on the side of caution by putting extra money in, which is why we've seen a couple different rounds and more to come, as we've heard from the Federal Reserve, that they will infuse whatever capital is necessary to keep the liquidity in the fixed income markets.
Yeah, based on, kind of my calculation, I mean, we were at the high there on March 6th, and by the March 18th, there was a 10% drop. So not very many trading days in a asset that typically does not have a lot of volatility. So it was definitely needed, and the learning that they had in 08, 09, I think has assisted here. Also, we talk about, this is a rescue plan versus a stimulus, right? More to come, Matt. So don't you think we don't know how many more to come, but it could be multiple layers of maybe more rescue plan before we get to a stimulus, but it still could be multiple layers.
I would agree. I think we're going to see more come. I think they're trying to figure out what that looks like. If you think of the fact of where we were, it was a booming economy. Unemployment was the lowest it's been in 50, 60 years. Housing market that was just on fire. A stock market that was just incredible. Consumer spending was great. Consumer savings was up. Trade wars, with various countries, that was pretty much being stifled. So you just had a really chugging along economy that came to an immediate halt. And so whatever it's going to take to get that back to where it was, I think that's what Congress and the Fed right now is saying. We just need to start throwing some money at stuff and see what sticks is almost what it looks like. But I think to Bill's point is, we saw that 08, 09, it took 18 months for them to really implement a relief plan. And we're seeing this within weeks at a time. So I do think that they've learned a lot. I think they're acting swiftly. Who knows what's going to look like down the road, but for where people are at right now, it's needed. And I think the immediate relief is definitely going to help a lot of people, especially when these stimulus checks start coming in the mail.
Thanks, Matt. Thanks, Bill. We have a couple resources available for you that we want to remind you of on Hilltop Wealth Solutions. We have a volatility resource center. It gets updated often, and so you can resource some things there, as well as we have a weekly webinar That happens on Friday, 3 o'clock Eastern, and you can join up on the website. And also, we offer a 30-minute second opinion call that you can schedule. Be glad to talk to you and see if there's any guidance we can give you. When we return on Your Wealth Health, we're going to talk about your goals. Should you think differently about your goals? How should you think about your goals? And what changes should you make to your goals? Thanks for joining me today on Your Wealth Health, and we're continuing to practice social distancing. I'm here in the studio with my cameraman, and Bill Davis and Matt Aurenz are broadcasting from their homes. And I want to switch a little bit to talking about rethinking your financial goals, and should you rethink your financial goals. And so this certainly, what's happened here in the last few weeks, there needs to be a relook at their financial goals. And Bill, we encourage people to always update their goals and make sure that they're on track. But in times like this, it's really extra important.
Yeah, that's probably the biggest concern that people are expressing to me is, okay, do I need to rethink the timing of my goals? And in most instances, the answer to that is no. But there is some short-term actions that we're looking at that someone should consider. You know, they're going to increase the unemployment amount. So if you are actually furloughed from your job, hopefully they're going to give you a greater unemployment payment. So we need to be cautious on how we use that. We talked a little bit on the last segment about the stimulus checks that are going to be hitting your bank this week, and then certainly the planning of for businesses with PPP money that's coming in to keep employees. But yeah, if you've done some planning up to now, and whether it's retirement, whether it's a college goal, whether it's buying that next car, most commonly there's going to be opportunities that exist that's going to give us planning opportunities. Zero interest loans, deferral on college payments, just a lot of different things that are going to be there that we think will be planning opportunities in the weeks going forward.
Yeah, and Matt, we recommend often, there's a lot of free websites to do some calculations. If someone has a retirement plan at work, they can go on often and do kind of some calculations there. But really, it gets a lot more complex than that.
It's much more complex. A quick calculator on your retirement planning website, your 401k website, really doesn't take all the other components of your life into that. You have to look at insurances and estate planning and tax planning, retirement planning, education planning. That just gives you a kind of a straight line look, a straight line approach. And the linear method is traditionally not the best method. So we definitely want to take a look at different theories that use different interest rates, different investment returns, some extreme measures to see are you on track or not on track for your goals. And we often find that people don't even have their goals listed out, what the assumptions look like, what the values of those goals look like. And so that's really where we want to start. If you've already got those, then it's just, okay, based on what's going on economically, how does that actually influence my goal? Is this something I really need to stress out about? Or is it something that I can just a couple small things and manage and work right through, and I'm right back on track?
Yeah, thanks for that. And, we also think it's important as you have someone helping you and guiding you along the way that you should consider whether or not they're a fiduciary advisor. If you take a look at the screen, you want someone that cares about you. You want someone that has experience in working with your particular situation and has experience that have been through the economic challenges or similar economic challenges as we're going through today. You want to understand their fee, their transparency, and really, is it in your best interest? How do they get compensated? Really, what is their service model? How are they going to service you? Because every situation is different. Whether or not there's a holistic approach. So we need to make sure of that. And do they have regulatory knowledge? Do they understand, the regulations around giving advice? What kind of communications do they have? Do they have proactive communications? Are they staying in touch with you? And then lastly, what kind of succession plan do they have? If they're going to retire or maybe not be in the business, where do you end up? Because oftentimes we build relationships for many, many years, and you want to make sure they have a good succession plan in place. And so, it's about, Bill, don't you think, having that good relationship, knowledgeable advisor that has your best interest in mind?
Well, absolutely. I mean, we're in touch constantly with our clientele, and we know their goals very, very well, and understand how to leverage the excess cash for retirement income distributions. Probably the biggest mistake that I saw with some people in 2008 was they were taking their retirement income from a declining asset, and that can be catastrophic. So the know your client, getting to understanding the future income streams they're going to need, and allowing to then have a plan, an investment plan that's reasonable return based on the risk that they're taking.
Yeah, it's a great point. And then updating it, and certainly thinking about, I think many will think about their plan a little differently after we get through all of this. And as we say, kind of, retool the plan itself. But we also encourage people not to make decisions just based on emotion. And so things like your investment decisions and things like, well, I wasn't going to draw Social Security, now I'm going to draw it. You would just want to make sure, is it still in the best interest financially for your situation? And again, not base it on emotion. We've talked about on previous shows about control the things that you can control. So you can control, as Bill mentioned, savings, cash reserves, making good financial decisions. And there's things that we can't control. And then over the next many coming weeks and months, we can't control it, but control the things we can control. So, Bill, Matt, thanks for joining me today. I appreciate you coming in and we doing this remotely. There will be a point in time we'll be able to be back into the studio. So we appreciate that. We know on Your Wealth Health that right now health and economic conditions are up in the air. We don't know exactly day to day almost. Things change. And so, we on the show have tried to broadcast what's happening now and bring information to you to help you think it through. But we also know there are going to be other important topics. And so if you look at the screen in the future, we're going to have cybersecurity, Social Security. We're going to talk about reverse mortgages, retirement travel plans, which we'll be able to retire, and college planning. So with that, I'm going to say goodbye. Thank you for Bill and Matt. I'm Erik Brenner. We'll see you next time.